Hello and welcome to Enter the Boardroom with Newroll. I'm your host, Oliver Cummings, CEO of Newroll. Today's guest, Suranga, is General Partner at Balderton Capital, a European technology VC fund with over $4.5 billion under management. As well as sitting on 9 portfolio company boards, Suranga is an advisory board member at the Cambridge University Endowment Fund and Diversity VC, fellow at the Royal Academy of Engineering and RSA, and a young global leader at the World Economic Forum. Formerly, Suranga founded Blinks, which he took public and achieved a market cap in excess of $1 billion, having previously been an early employee at Autonomy before leaving as the US CTO. Suranga, a huge welcome and thank you so much for joining us today.
Thanks for having me, Oliver. It's great to be here.
Suranga, can we start with your own founder journey? And I'd love it if you could just talk us through the highs and lows that the board and board members played in that journey for you.
Yeah, absolutely. So my own founder journey was, I think, not dissimilar to many of the founders I work with today. We were a technology startup, ultimately grew and eventually went public. So we went through this sort of quite a long arc, about 10-year journey for the time that I was actually a CEO. And my board was actually fairly static through most of that period. We had a couple of changes, but nothing major. I was really lucky because on my board, I had multiple people who'd been CEOs before, including 2 people who'd actually been, not for the entire journey, but for most of the journey, I had 2 people who had been public CEOs before. So they'd really gone through a lot of the same things as me. One of them had been a startup founder, so really understood the journey from the very beginning. The others had not been startup founders, but had certainly been operational and run companies and so on before. So I had a nice mix that way. And I think quite a good, being on a board was not something I'd spent a lot of time planning or thinking about before I had one. And so it was quite handy to have people who'd been through it before and who'd stood in my shoes and therefore understood what to make of the board and what not to make of the board, as it were. And I think some of the things I learned in that journey are still things I do today, frankly, on all the boards that I serve on right now.
So talk me through some of the ways in which they added most value. Can you give me examples?
The most important things were around really how I was spending time. So for example, I remember that there was a particular meeting where, I'd do what I'd always do, which is turn up and do a lot of reporting and explain how the business was doing and what was working and what was not working. One of the board members, Mark Opzuma, who had been a CEO before, he'd also worked at Yahoo before, and he sort of motioned to ask some questions. I thought he was going to ask me about the business, but he didn't. Instead, he asked me all about myself, and he was asking where I was spending time within the company, what I was working on. And he looped it back into some of the sort of business units and product lines and so on that I'd mentioned earlier. But it was a very different set of questions. It was more about where I was spending my time and my focus. And then that turned into effectively a sort of slight coaching conversation where it became obvious that I was spending a lot of my time really maximizing and squeezing the last drop of juice out of some of the things we were doing. And what I wasn't doing, for example, was spending any time looking forward and thinking about strategic, bigger challenges or opportunities on the horizon. And then the advice from the board was then you need to ensure that you've got enough time to do that kind of thing. When you've got a business that's working really well, it's really easy to stay busy doing the stuff you're doing right now. But actually, as a CEO, at that point, your job is to let the business that's running well run itself to some extent and go off and figure out what comes next. And so to me, that was a great example of where a board member can be a mentor or a coach. It was less about his fiduciary duty to the shareholders, and it was more about making me be a better leader, realizing that would then have the benefit, of course, of hopefully increasing the value of the company in the long run and therefore benefiting shareholders. So it was an interesting thing, which I'd never really experienced before. Until that point, I'd never thought of the board as a group of people who were going to coach me or teach me or mentor me in any way. And that was a great example of that. Again, didn't expect it, but it was really powerful when it happened.
What other highs were there in terms of the board's contribution for your journey as a founder?
The other critical moment when the board really helped, I wouldn't know if it's high because it was actually a low, but the board was very helpful. I vividly remember the very first time we had a bad set of results on the public market. We had taken the company public. The IPO was super successful. It was multiple times oversubscribed. We then had a quarter or two of fantastic numbers. Everything was going up and to the right. Everyone was very excited. Everybody wanted to meet us and people were buying the stocks. The share price was going up and everything else. And then we had the global financial crisis. It was the 2008, 2009 financial crisis. That obviously affected everybody and everything on the market, but it really hurt companies like ours. We were effectively in the marketing or advertising industry, and that market obviously really got the wind taken out of its sails. So we saw that in the form of much slower growth, and also being structurally a company that was a high growth but also unprofitable was very out of favor. When you get that kind of market conditions, people want profitability more than they want growth. And so we went from being a darling to being a zero overnight. And that was just really tough, because when you do that as a public company, the arena in which this all occurs is just very public. So people write about it in the newspaper, and your mum picks up the newspaper and reads it, and they're writing sort of nasty things about you and your company. And that can feel quite upsetting when you go through it the first time. And so the board was crucial at that moment, because they were the people who'd been through similar things before. Most of the other people I had to talk to had not had that journey. My colleagues, my exec team were fantastic, but they'd never been through anything like that before. That sort of thing that your friends have been through or whatever. And even other CEOs I knew, most of them were still private companies. So I didn't really have anyone to talk to. And I remember talking to, in this case, Mike Lynch, who at that time was the CEO of Autonomy, and they were public as well and had been for many years. And I called him up, and it was actually for a functional reason. I called him because I had to show everyone the press release before it went out for the results. So I pinged it to him, and he'd emailed me back and said, hey, could you give me a call? I had a couple of questions and some of the detail. So I picked up the phone, talked to him through the detail, and then he said, so how are you feeling? And I'm so glad he asked that question, because then the waters broke, and I poured out all this kind of anxiety and concern. I knew that it was going to hit badly, and that when it did, it was going to come with a lot of deluge of negative press and everything else. And again, he was just fantastic at just being a huge emotional or psychological supporter at that point, and just saying, look, this happens to everybody. And we joked a lot, and he talked about examples of terrible things that had happened to him in similar situations. We talked about other CEOs who had way worse news than me, and how it put everything into perspective and so on. And that was a really important thing. Very almost paternal moment, which again, I think the right board can do. Not because they're necessarily older than you or more experienced than you, but again, it sometimes is that very human side of being able to bring some perspective to a situation. Being a CEO is an incredibly lonely job. It's almost a cliche, but it's a cliche because it's true. And again, if the board plays it well, they can't be there with you for everything, but they can certainly help a lot more than many other people can.
Yeah, I love that Brian Halligan quote of being CEO is overrated, which I think anyone who's been CEO will certainly resonate with at some level. Talk to me about the lows of the board interactions as a founder.
One thing that I found was that the business I was in, the board did not have a huge amount of direct experience in our actual market. So the board members most of them had experience in the technology industry. And so they understood aspects of what we did, because at the core, we were a tech-powered company. But we were a tech-powered company selling a product into the marketing, advertising, and really publishing and content media industries. And these were industries that actually most of the board had no experience of. And that was a tough thing, because I think there were times when we had challenges due to the nature of the kind of customers we had and the way that they would interact and the way that they would react to situations. And you try and explain those things to the board, and the board didn't really get it, because they were used to selling to very different customers. And so there were moments like that when, on reflection, I think at the time I didn't really think of it that way, but on reflection, if we'd had more industry experience, it would have been less frustrating, a set of conversations, because there'd be someone there who would say, yeah, that's how they react in this sort of environment or this sort of economy. So here's how to deal with that. And also there'd be people who would be able to help us more tactically with everything from connections to providing relationship cover and things like that, because they know some of the people in the industry. And I didn't get any of that. So again, in hindsight, if I was doing it again, I'd probably add one or two people who came from the industry and really bring them into the fold. And I think it's one of those things that mattered less when we were smaller, frankly. But as the company got bigger, certainly after we went public, it became quite critical. And again, in hindsight, we should have perhaps added someone. I know that the CEO that I appointed when I left the CEO role, he actually did that almost overnight. He changed part of the board, and one of the things he did was bring in someone who had a more of a marketing background. And from what I understand, that worked really well for him. You know, that's something which I now think about with a lot of our portfolio companies. As the company gets bigger, there's definitely a lot of value in having people who've worked directly in the industry that you're operating in.
If you had been a board member on your business at the time that you were approaching the exit, knowing what you know now, what advice would you have given yourself?
That's a great question. I think the biggest bit of advice you can give CEOs as they approach an exit, and I'm not sure I got this, was, I certainly didn't get it explicitly, is, step back and make sure you are doing this, that you really want to do this and that you're doing it for the right reasons. I think that the problem with exits, so whether you're being sold to another company or whether you're taking a company public, is that they become a sort of process that has its own energy and its own momentum. And so when you start off on it, before you know it, you're like a train on tracks and you're just going, and then you start executing, and it's hard work, right? But whether you're you're selling a business to an acquirer or taking it public, there's a lot of effort involved, a lot of diligence, a lot of legal work, a lot of accounting work. And so you end up getting caught up in that process and all of that work. And before you know it, that's what you're focused on. Where in reality, again, it goes back to what we were talking about strategy. The really important thing as a CEO is to step back and say, is this strategically what we really want to do as a company? Like going public, is it really valuable for us? Is the money we're going to raise from that IPO actually of significance? And is the independence we will give up by going public worth, is that counteracted sufficiently by the capital we can raise or the profile we can benefit from if we're public? And equally with selling the business, do we actually want to sell the business today? Am I doing it because I'm flattered by the interest? Am I doing it because I happen to be tired this year and actually a break would be more useful? And I think it's just very easy to just get caught up in what's going on. Whereas it is really important to sometimes step back, take full perspective of the situation and make sure that you're doing it for the right reason. I didn't get that advice specifically, and maybe we should have. In a way, I'm really glad we went public because we went public in 2007 and the timing was great in the sense that if we'd not done it that year, we'd have had to have waited 3 or 4 years. However, if we'd waited 3 or 4 years, we would have gone public as a much larger business with profits. And so the whole experience would have been very different. Again, I'm not sure which was better, but I'm not sure we even really thought about which was better. We just saw the window and grabbed it, which worked out fine, but who knows?
We shift perspective to your experience now as an investor director. I had a number of discussions recently firing off in my various scale-up CEO WhatsApp groups, lamenting the pain that is their board, which I would say the vast majority of them see as necessary evil, something to be tolerated, and often something that is value destructive. In preparation for this, I reached out to one of your portfolio company CEOs, who gave me this quote, which I thought was great. I won't share it all, but he said, Suranga's additions to the board post-Series X marked a significant turning point for the company. With his extensive experience in scaling technology startups and deep understanding of the X landscape, he brought a wealth of strategic insight and industry knowledge to the table. His ability to foresee market trends and identify growth opportunities was instrumental in guiding the company through its critical early growth phases. His expertise in product development and customer-centric strategies helped the company refine its offerings to better meet the evolving needs of the industry, positioning as a leading player in the market. And it goes on.
Wow.
It was pretty much a war and peace. I was quite taken aback by that. And I think that makes you quite unusual as an investor director. So I'm curious to hear, given you sat on both sides of the table as both an investor and an operator, and you're obviously doing a good job of it, at least from that portfolio company's perspective, what are the patterns that you see the good boards are doing? And what are the patterns that you see that the bad investor directors are exhibiting?
First of all, that's a fantastic quote. I think the most important thing is to think everybody who's going to be on that board owes it to themselves to constructively think about what they want to get out of the board and how they want to make it productive. Because to too many people, actually on both sides, both the CEO management team, but also actually the board members or the non-execs can look at it as being a sort of necessary evil. They can look at it as a bit of a chore. And there's no point approaching it that way because it's going to take loads of time, right? There's loads of prep involved for the management team. They have to produce all the materials and everything else. And then there's the actual board meeting itself. For the non-execs, there's usually travel and a lot of disruption to get there. You've got to read everything beforehand. And you've got to be in the meeting itself. If you're not going to make it constructive, don't bother. It sort of staggers me that people turn up to these things, essentially spending days of their time to do it and then complain about the outcome or the experience they have. You wouldn't do that for anything else. You wouldn't go away for a weekend, have a really terrible time because the hotel was terrible and the weather was terrible and the place was ugly and whatever, and the person you went with wasn't very nice, and then go again the next weekend without changing something. You change it. So I think that's the most important thing is, you're going to do that. You're going to have these board meetings. That's going to happen. So first things first, sit down and figure out what it is you want from them and make sure you communicate that and get there. And different boards want different things. And also what they want at different times of the company's journey are different. If you're not spending actually thinking about what you want to get out of it, then you won't get what you want out of it. And then it'll be a bad experience and then you'll be frustrated.
Can I throw a challenge at you? So I say the same thing to founders when I hear that. Now, what they will often come back and say is, look, we've got these flipping investor directors who come in and they've got their way of asking questions, the things they're interested in. They are of no value to me. It's just so that they can report back to their investors. I can't change them out because they've got a contractual right to be there, and they can't teach me anything about my industry or my product, and I don't want their opinions on product or whatever it is because they don't know anything about it, or they know very little. You must have seen this, right? You must have seen those investor directors from other VCs who are disruptive influences in the board. What's your approach?
Yeah. So first of all, if you take an investment, then you have agreed to a relationship where someone else has given you money, usually not their money that they have fiduciary duty over, and you've taken that on to be able to fuel your business. No one forced you to do that, right? It's perfectly possible to build a business through bootstrapping, and there are many companies that do that. So if you are going to take money in from an investor, then wake up. There's going to be responsibility attached to that. You don't just get money for free, right? And so I think complaining about that after the event seems immature at best to me. Now what you need to do is think, okay, well, if I'm going to take investor capital, and I know that part of the cost of that will be someone on my board for a long time, then guess what? Pick the right person to be on your board. So spend some time really looking at who the options are and picking somebody who you think will be genuinely beneficial, someone who has some kind of experience. I agree with the point that most of the investor directors will rarely have experience in your specific industry or product, a bit like I described with my own board. We didn't have that. Should have brought it in from outside. But they are people who will have been through the CEO journey before. There are people who will understand certain markets well. There are people who will just have experience of having built other businesses that are similar to yours in some other way. You can look at it in a broad set of ways, but look for someone who you think will have interesting insight or input or knowledge or network or whatever it might be. And sometimes it may be that they aren't the most interesting, spectacular person for the board, but they come with an investment firm that has a lot of value that they can bring to you. And actually this person's just a great, helpful partner who can help you access all of that help and assistance and resource. You can look at it in lots of different ways, but I think you owe it to yourself. If you're going to take capital, realize that part of that comes with the need to work with these people and then spend the time to pick the right person. And I'm always amazed at how many CEOs will take money from the highest bidder, and it's insanity to me. Of course, you shouldn't take money from someone who's bidding you half the price that someone else is, but you shouldn't be just thinking about your valuation or a simple metric like that. Actually, who you put on your board is such an important thing. Put some time and effort into that. And then you realize you've now hopefully got someone more helpful on your board, more constructive on your board. At that point, you've got to realize that yes, there are bits of what they need from you that are not particularly interesting. So the reporting is a great example of that. I work for a firm. Our firm has funds. Those funds have to be reported on. There's a whole bunch of metrics I need for that. Guess what? You don't have to use the board meeting for that. It's perfectly okay to produce that set of documentation and just put it on the side, provide it to me ahead of time or whatever you want to do. And then that way the admin, so sort of necessary evil admin function gets done. It's the same with things like every board meeting has sign-offs for sort of simple financial transactions, or maybe it's options for employees, or maybe it's shuffling money between two different subsidiaries in the business structure or whatever. As a board member, I get annoyed when I have to sit there listening to a CEO literally reading out the names and numbers on these sorts of things. This is a waste of your time and my time. Unless it's something really unusual that needs actual discussion, like someone with a particularly large equity grant because they're a really special employee you're trying to land or something like that, then send that ahead of time. And so that all that transactional stuff on both sides, frankly, your side and my side, can just get done with and maybe even just done on email and never even spoken about. And then you can focus the board on actually having a constructive conversation. And again, if you've done the bit I recommended at the beginning and actually pick people who are relevant, now you know what these people can bring to that conversation. And so go ahead and pick 2 or 3 topics you want to talk about that you know this person's going to be helpful on. So I have some sympathy for what you're describing, but I also think people have often put themselves in that position. Yeah, try and take a bit more control of that situation, I think. The only case where I think it is really tough is when you work with an investor and you have a fantastic board member and then that person leaves the investment firm and you get swapped out with somebody else. And that's unfortunately a real luck of the draw type thing. Sometimes you get someone even better, which is fantastic. But sometimes you get somebody who, not their fault, you would have never chosen to work with them. They would have never chosen to work with you. And now you're stuck together. So I get it. That's more painful, but really that's a pretty limited example, I would say.
My advice to founders with that is always make sure you understand who the ultimate decision maker is. In every fund, although they typically have an investment committee, there's normally one key investment decision maker who has their name above the door, and make sure you've built a relationship with them so that if that happens, you know who you're really getting married to. I think it's really important. I was talking to a CEO who had a toxic board and has actually just changed it up and now has a really high functioning board. And he went to the investors and said, look, you need to change your representative out because they're just not adding value. And then he also brought in an outside sector specialist. Have you seen that happen much, where particular individual investor directors have been off-boarded and replaced with someone else in their fund, or actually just taken off the board altogether and you've had an agreement, look, this is not adding value for us, you're not getting value out of this, why don't you just step down?
Yeah, I've never had a sort of toxic situation like the one you're describing. What I have seen, and I think this is another great thing, is egoless transition off boards. And I think that can happen and it should happen. For example, a number of the really excellent seed funds that we have had the pleasure of co-investing with have a policy where when the company's at a certain point, they have a conversation with the CEO and say, look, I think I've done what I can do. You've now got more board members. The last thing you need is yet another voice around this table. Maybe it's time for me to step down. And by the way, if there's some formal seat attached to me, we can talk about replacing me with someone who's maybe got industry experience, or I can just remove myself from it and I can be a vote on the side, or there's a number of ways of handling it, but basically having that proactive conversation. I've seen Point 9, which is a really well-known seed fund based out of Germany, but invests globally, and Fly Ventures, which is again, pan-European seed fund, has more of a deep tech focus. Both of those firms do this proactively. It's not like it always happens at Series B or whatever, but the directors really think smartly about whether they're really adding value anymore. And they add huge value in the early days. Both of those firms have amazing expertise at helping companies at the very early stage, but they don't have an ego about saying, if we're not helping anymore, let's step down. Now, I think if there was a case where the partner was someone who really knew that industry well, they'd probably offer to stay on, or would certainly happily stay on. You can get a bit caught up with the identity of your board that you're involved with, and actually it's smart to think about what's best for the company.
I always think you learn most about people when their chips are down, and that's one thing I always encourage founders to do, is to speak with founders whose companies have blown up with that particular investor director. Obviously, we've been through quite a few down rounds and even liquidations over the last recent sort of history. Curious to hear, what for you have you learnt from observing other investor directors on the board through this period?
Yeah, very early on in my venture career, a very experienced VC was having a chat with me, and he said the funny thing about VCs is they just flip-flop constantly between states of greed and fear, and very little in between. And actually, he was joking about it, but he's absolutely right. And what we saw a lot over the last couple of years was a lot of fear. And the problem with fear is that it leads you to irrational behavior. Was the market tough? Yes. Were there companies that were burning too much capital? Absolutely. Were there companies that were just never going to make it in the end because they were a company that was never going to make it, and under a tougher economic environment that was going to get exposed earlier? Of course. But does that mean that every company was in that situation? Does that mean that every company that missed a quarter was dead? Of course not. And yet the way that some investor shareholders behaved really was akin to that. And it was pretty appalling, honestly. I saw some pretty terrible behavior where really people were just getting scared and then panicking and then massively overreacting. And that overreaction can come out in lots of different ways. It can come out in literally sort of anger and raised voices and frustration at board level, not constructive, not productive at all. And it can also lead to things like really drastic decisions, laying off a huge chunk of a company or whatever, and not thinking at all about what the implications of that are. There's a lot of sort of stupidity in that. It's not fair to say it's all the fault of the investor directors. Management teams also lost their heads in that kind of environment. But the difference there is they do have to live the reality of whatever it is they're doing. And so I think they tend to take these decisions a little bit more seriously because they know they're the ones who are going to have to let go of those people, for example, or still hit the number with fewer people, or whatever the challenge might be. Whereas as a board director, because you're a bit removed, it's easy to have these very binary black and white sort of changes of sentiment. And I think there was a lot of that. At the beginning of 2022, we'd had one of the longest bull markets in technology that we've ever seen. And so there were many people who had either never seen a downturn or saw it so long ago that they were very sheltered from it because they were perhaps quite a junior person at that point. And CEOs, management teams, board members, everybody was learning on the job. And as a result, when you have that, you tend to get some stuff that doesn't quite work. On the flip side, there was some brilliant stuff as well. There were some boards I was on that were businesses that were really struggling, and yet there was exceptional behavior and really mature decision making, even though in some cases the outcome was ultimately a liquidation.
But so what is the lesson from that for a board member listening or for a founder listening to this to ensure that history just doesn't repeat the next time we enter into that panic mode?
There's a couple of things, right? So first of all, it will repeat because in an ideal world, you would run your business in a more steady way and you would grow slightly slower, but you would burn less and therefore you'd be able to absorb some of these extremes in the market. The reality is that there will still be extremes in the market. When those extremes hit, you will be forced to move one way or the other. If there's lots of effectively cheap capital lying around, you have to grab it and use it to grow faster, because if you don't, someone else will and they'll take your market share away from you. I think you need to realize that these sort of volatile moments happen. And instead, really, it's about realizing that a lot of that is externality. A lot of that is decisions that have already been made. And there's really little point in reprocessing that and blaming people at this point in time. Instead, it's all about, okay, based on what we have today, what can we do from here? And it's there are a lot of sort of classic financial decision-making challenges that people hit and that kind of thing. You get a lot of sunk cost fallacy type thinking. You get a lot of survivorship bias type thinking and so on. So it's all stuff that people know and people are very aware of, but it's very easy to get caught up in it. And I honestly think the only way you can learn to do these things better is to live through a few of these cycles yourself, because when you've done that, you spot the behaviors and you realize that you see it in yourself as well. And you realize, okay, I'm not immune to this. And when the market turned, I felt at times extremely negative about certain companies and their chances. But if you've been through that kind of journey before, you also remember that, okay, I feel down about this today, but let's not make huge dramatic decisions on the basis of that moment of anxiety that I'm having right now. Let's make sure we do it in a slightly more mature way. You can do that, but it's tough and it's part of what makes the job hard. And it's the reason why it's a highly compensated job when you get it right.
It's interesting. It ties nicely with the recent podcast I did with Dan Gardner, the author of How Big Things Get Done, Super Forecasting, who was talking about reframing decision-making away from emotion or non-emotional towards system 1, system 2, that either it's gut or it's analytical. And that one of the key sort of functions you've got to assess is the time that you have to make the decision. And if you've got time, take whatever time you've got. Exactly. And I wonder if listening to you there, it sounds like actually some of the things that went wrong there were people panicking and perhaps not using all the time that they had.
Yeah, absolutely. The opposite is also true, right? People thinking they have time when they really don't have time. One company I'm thinking of right now where one of their investors had written a fairly well publicized memo about how the market had turned and it was time to make drastic changes to your business. And the CEO, I think, took that a little bit too much to heart. Within a week of NASDAQ flipping or whatever the moment in time was, he'd written a 10-page memo to the whole board outlining how he was going to change all kinds of things, including laying off a decent chunk of the team. And it was just too much of a reaction. We didn't have to do it right then. We had loads and loads of cash. Actually, it wasn't a particularly high-burning company. And so if nothing else, we could have said, this has happened. We should think about making changes, but let's take a month and do it properly. And instead, he'd written this thing pretty much in isolation on his own, I think, with his CFO, and that was it. And he hadn't even talked to the rest of the management team about it. And meanwhile, there were other teams where there was this sort of desperate clinging on to what the way the market had been until recently, and this assumption that they'd be able to raise money somehow, and you watch them slowly get dragged down and down. And of course, their cash base is shrinking all the time because they're burning so heavily. And then when they finally get it and the penny finally drops and they realize it's time to make some changes, perhaps grow a bit slower, perhaps cut some costs, it's too late. The changes they can make at that point, sure, they extended the runway, but only by a very short period of time. And then they're in real trouble. So it's really tough. You do have to think a lot about how much time you have, but in the emotions of the moment, it's quite difficult to think that way.
What, as a sort of board member, what was your contribution to those processes? What were the most useful bits of insight that you were able to share with your CEOs to prepare them for that?
I think the most important thing we did, that the boards did in those things generally, was get the CEO to the point where they actually did it. Because I think for most CEOs, it's just not something they want to do. And therefore, if not pushed, they would rather not think about it, rather not really consider it. And actually, they have to, particularly first-time CEOs and certainly people who've never done that sort of thing before. And a big part of the role of the board was to say, look, you've missed 2 quarters. We know from the economy that you're probably going to miss the next 2 as well. That's okay. That happens. We still believe in the business fundamentally. Maybe we're even going to do an inside round to give you a bit more capital so you can feel confident. But we're going to have to be a more efficient company. And let's start having that conversation. And again, it goes back to the advice you mentioned earlier of if you've got time to do that properly and have it across multiple conversations, that's fantastic, right? But So I think that's the biggest contribution, was just like catalyzing those moments. Once you know someone's going to do it, actually, I think it often becomes quite a company-centric thing, not a board-centric thing, because really the CEO, wants to talk to their people, right? And explain why it's happened, and often talk individually to as many of them as he or she can to really ensure they get the news from them. And then there's a bunch of tactical things you can do around how to structure these things. I definitely did a lot of coaching at that time, just with the CEOs, helping them feel good about it. My very first job out of college, I was laid off about 6 months into the job. It was the dot-com crash. And so I joined this company in the dot-com boom, at the very end of the dot-com boom. Everything was growing really fast and it felt amazing. Then I lost my job 6 months in, pathologically, and it was a really tough moment for me. One of the things I really remember about it was the CEO was terrible at managing it. He organized, it was a big company, so he organized a hotel ballroom. We all had to go there on a Saturday morning, and he stood on a little platform at the front, and he obviously had a little speech that he was going to give, and the conclusion of the speech was going to be, and we're going to lay off a third of the company, so about 30% of the workforce. But he couldn't get through it. So he started talking, then he started crying, then he apologized and ran off and left it to his head of HR actually to run the process from there. I had a good sort of academic background, so I bounced back on my feet and got a good job and everything else. But to me, that was a real lack of leadership in yes, it's a tough moment, but that's when you need your leader the most, right? And so I did a lot of mentoring chats and so on with CEOs saying, look, this is a really tough moment. Be tough for the team. Be there and be with them. And if they're mad, if they're upset, be mad and be upset with them and show them that that's okay. And these are reasonable reactions, because they'll thank you for it one day, even if they don't thank you for it today. And I think, to be fair, most of the CEOs I work with did do that. And they did a much better job than this other guy that I'm mentioning.
Can we move on to talk a little bit about the sort of board hiring and composition? Curious to hear, when do you think is the right time for a founder to have a board? By the time you come along, I guess most founders probably don't have a board, but if they do, would it change your perception on them as an investable opportunity? And if they don't, when do you think they should start?
Yeah, talking about technology startups, I think you should really definitely have a board by Series A. I think it's okay to have made it to that point without a formal board. Many companies do, but I don't think it's essential at that point. But I think certainly by the time you get to Series A, you should have a proper board. And the good news is there's very standard paperwork and structures on this sort of stuff. So it's not like you have to invent anything new for yourself. And I think the most interesting thing at that point, though, is that board, it's important at that point to try and keep it a fairly tight board. I think where I've seen real issues is when those early stage companies, you have to be able to react quickly. You have to be able to change things rapidly. And you can't do that if you've got 7 people on that board. Thinking really smartly about who's actually on that board is crucial. And by the way, I don't mean just the formal board members themselves, but also some boards have this tendency to pick up various additional people. Some of the investors will bring a junior person with them. Some minor investor might ask for observer rights. A co-founder who's not really on the board might just want to sit in on board meetings. And actually, I think it's important to be a bit tough with people at that point and say, no, look, we're going to have just the people in the room being the people in the room. Otherwise, it's just so much conversation, so much discussion. And even if certain people who are in the room don't technically have a vote, the fact they're in the room sways the conversation and makes everything slower and makes everything a bit more dilute.
I always say that to founders. If you've ever had an argument with someone where there's no one in the room and then you have to try having that same argument with someone else in the room, even though they say nothing, you know that it changes the dynamic, its face and human nature. Yeah. You've got there's a really good pack that Balderton have done on how to think about board composition, and you're very clear in how it builds up. Typically Series A, you'd have probably a couple of investors on the board, possibly including the seed investor, and then maybe an independent. And then by the time you're moving through Series C, D, and to IPO, you're looking at typically 1 to 2 independents and a chair.
Exactly.
I'm curious, I know from researching this call, you have a playbook for selecting founders to invest in. What's your playbook for selecting a chair?
Yeah, there's no specific profile that we think works in every case. What we look for most in a chair is someone who can build a really deep, meaningful relationship with the CEO. That for us is the critical thing. We're really looking for a partner for the CEO. And so it's usually someone who's had pretty substantial operational, probably entrepreneurial experience themselves, because that way they can really empathize with the position that the CEO is in. It's often someone who knows the industry fairly well, because again, it means that they can provide that kind of lateral viewpoint that's very helpful for the CEO. Most importantly, it's just someone who's both capable of and willing to put the time in required to really engage with the CEO, build a relationship with that person, and be that person's right-hand man or woman, and be someone that they can feel they can have that trust with, so that they can pick the phone and call them if they need to and share that really awful thing that's just happened in the company or whatever else it might be. That's what we're looking for more than anything else. And frankly, if you can get that loyalty and that kind of relationship, I think a lot of the rest follows. Then that person wants the best for the CEO, which translates into usually the best for the company. And then they think about the rest of the board members as resources that can be exploited to make the company and the CEO perform better and have more success. And that's exactly how we should be used. So I think that can work quite well. You sometimes get people who want to still be really operational, exec chair type role. And I think while there are cases where that can work with the kind of fast growing startups that we're backing, usually you really need one leader. And it's tough when you start to dilute that message a little bit with someone else who's also calling the shots sometimes. There are unique cases where it works, but generally we avoid that. We're really looking for someone who's done it all before, but really doesn't want to do it again, but really would love to share the experience of what they did find with someone who they just get on with, and someone who they look to and say, I want that person to be successful, and I'm going to help that person be successful.
Suranga, time has flown, which means it's time for the lightning round, where I say a short statement and ask you for a quick response if you're ready.
Sounds good.
Best book every board member should read and why?
So I don't read business books. I find them quite structured and really about frameworks and processes. And I think being a board member is really all about understanding human interactions and psychology and really the sort of incentives that drive different people, some of which are very structured, like I'm an investor, therefore I need to get the best return on my investment, but some of which are actually much more to do with where this person comes from, what their background is, how their life is going right now. And I would say, rather than reading any specific board books, read fiction. I think all business people should read more fiction. Everything from modern stuff all the way through to, I think classic authors like Jane Austen are perfect for this sort of thing, all about the intricacies of how humans behave in different situations and why they do what they do. If you could understand people as well as Jane Austen understood people, then you'd be an amazing board member.
Reminds me of a teacher of mine who once said to me, fiction is like an accelerated life simulator, so read more.
Yeah, absolutely. Exactly. Yeah.
Boardroom behaviour that irritates you most?
It's that person who asks too many questions. You have to sit back and let the team lay out the full picture, the full story that they're trying to lay out. Some people cannot sit on their hands and wait for that and instead have to query every single detail.
Most valuable board ritual?
If you can do it, some unstructured time together, dinner, lunch, whatever it is. Boards are about people. They're about humans. And so just letting people connect in that slightly unstructured way is critical.
Most significant professional insight?
Focus is the key. The second CEO I ever worked for, who was a founder CEO, and had built a platform technology company which could be used in lots and lots of different ways. And he really taught me the importance of, on any given week, day, month, year, he always had a focus. And I think that's such a critical thing, especially if you're building a fast growing organization. It's so easy to want to do everything, but actually the critical thing in our gig is to understand what the most important thing is and just focus on that.
What have you changed your mind on about boards over time?
I think the biggest thing I've changed my mind on about boards is this idea of a highly active chair. So I'd had some experiences early on where I'd had chairs who were really too big a personality and almost detracted from the CEO. And I think that led me to thinking that a chair was a bad idea and it was better to have a flat structure where there wasn't someone who was sitting slightly ahead of everybody else. Thankfully and happily, since then, I've seen other boards where a chair has been an incredibly powerful thing. And so I think chairs are actually really important now, conversely, but I think picking the right one is crucial.
When was the last time you got a significant judgment call wrong in the boardroom, and what did you learn?
The biggest one that we did recently was a big product strategy call. So it's essentially this security software company. They had two product directions they could go in. We picked A, our competitor picked B, and B turned out to be the larger market. And it turned out that if you won B, you could easily pick up A over time. And we completely lost that. And I think the learning from that was really that it was a highly technical call in the sense that it was about the technology itself. It was about the specifics of that particular market. And frankly, it was a board of generalists. And we didn't have enough of an expert voice. The only expert voices we had on the board were the two founders, the CEO and the CTO. They provided some insight into it, but really we should have had an independent on there as well. This was a company that was a Series C company. So really at that point, I think ideally you do have at least one independent. We hadn't had one for various sort of historical reasons. And I really wish we had, because I think we would have, if nothing else, had a more rigorous conversation about this topic. And we didn't. We took it far too lightly and made the wrong decision.
How are you better today as a board member than than when you started?
So I think I have the confidence to shut up and listen a bit more. I think when you first start being a board member, and obviously not a CEO yourself, it's like everything else in life. You want to prove that you have value. You want to prove that you're there for a reason. And so it's really easy to end up talking too much and trying to sound your voice. And actually what you realize over time is that less is more. And it's actually way better to sit back, to listen, to absorb, and maybe make that one or two critical observations that will be helpful, rather than try to have your voice heard at every step of the way. But it takes time and confidence to get there. And so it's a hard journey to get through as a board member.
Finally, 3 things our listeners should take away from this podcast if they take nothing else.
I think the most important thing is to realize that the board you have is the board that you have created. There are some things you can't control, but I think it's much more in the control of CEOs and management teams than they think it is. So when I hear people complaining about their board structure or their board dynamic, if you can't change it, it's probably still because of some decision that you made historically. So I think understand that this is something that's going to be with you. Understand that therefore it's in your interest to make it a useful, positive thing, and then use that knowledge to make the right decisions along the way. Choose who you take investment from. When you think about those board meetings, structure them in a way that, yes, transactionally gets away what you need and what they need, but then focus the time on what you care about most and what you can get from these people and so on. So I think that's the most important thing. The second most important thing is to understand that different board members will bring different things. It's really important to think this is a team thing. Think really hard about the overall team you're constructing. In the same way you wouldn't hire 3 finance people for your management team, you'd hire a finance person, a marketing person, and a technology person. In the same way, think of your board that way. So even if you've got 2 VCs on your board, have different kinds of VCs. Have one that was a CEO who can help you with that kind of thing, and have one who's a brilliant financier who can help you with that sort. And as you get bigger, absolutely bring in non-execs and so on. And then the third thing I think that I would take away is this importance of perspective. It came up a number of times in the conversation at different points, but it's not just a board thing, but I think great boards encourage CEOs to behave this way. When you're a CEO, it's very easy to get caught up in the detail all the time. And it is important that you get caught up in the detail. I don't want to deny that, but it is equally important to be able to step back and look at things from afar as well every now and again. CEOs can very easily fall into trouble not doing that, and finding a way, a structure, a process, some kind of hack for you yourself to ensure that you do that on a regular basis is absolutely crucial. If you're lucky, a good board will help you do that. That's what happened to me. But if your board isn't doing that for you, then you've got to figure it out for yourself.
Suranga, I always love doing these with people who've been successful entrepreneurs, but to have someone who's both been a successful entrepreneur and investor has been absolutely magic. Thank you so much for taking the time to share your experience and wisdom.
Thank you, Oliver. It was a pleasure.
If you found this conversation interesting and would like to be involved in similar discussions, join the New Role Board community. Community membership gives you access to 24-hour discussion threads on boardroom challenges and opportunities like those we've been discussing, smart online networking events, one-to-one career sessions with our headhunters, third-party board roles, mastermind groups, and Q&As with senior board members. Head to community.newrole.com to find out more.